Greetings, Latin America, Europe, and Asia. Welcome to a new FLAR Talk webinar. My name is Yader Giraldo, Principal Economic Researcher at the Latin American Reserve Fund, and I'm pleased to moderate this webinar on fiscal buffers in the post-pandemic era. As we all know, the COVID-19 pandemic has had a significant impact on global economy, and many countries are facing a deterioration of their fiscal position. In particular, the ASEAN plus 3 economies in Latin America and the Caribbean have been hit hard. In order to review their fiscal buffers and to deal with the high levels of debt, these countries need to take a comprehensive approach that should include fiscal consolidation, debt restructuring, growth-enhancing reforms, and increased international cooperation, among others. To discuss these and other relevant points, we have invited Luke Hong, who is the lead economist and group head of the Fiscal Surveillance Group at the ASEAN Plus 3 Macroeconomic Research Office, AMRO, and Pin-Hung Nam, a senior economist who is responsible for conducting the fiscal sector surveillance for the ASEAN Plus 3 region, to present the recent research on rebuilding fiscal buffers in the post-pandemic era. After the study presentation, Oscar Valencia, lead specialist at the Fiscal Municipal Management Division of the Inter-American Development Bank, IDB, will discuss the main findings in the paper and present the Latin American perspective in this regard. Finally, we will have the Q&A session. So let me start and give a warm welcome to our first speaker, Luke. Over to you, Luke.
Thank you so much for your kind introduction. As introduced, my name is Luke Hong, Group Head in charge of the Fiscal Surveillance at ASEAN Plus 3 Macroeconomic Research Office, or AMNO in short. First, let me thank FLA colleagues for providing this nice event to share our work with new group of people. My presentation today is based on our recent published paper, policy perspective paper, which our fiscal team used to communicate with member authorities to share our view on the fiscal issues regularly. As mentioned, this paper was published 1 week before last Monday. So those who are interested, please check the AMNO's website for the paper. As the PPT shows, it's a collaborative work with Byung-hun as well as the other team members. But let me lead the presentation today. My presentation has 3 parts, basically corresponding to main sections of our paper. We will first go over some of the key fiscal developments in our region, and then discuss key challenges for fiscal authorities are facing. And then we'll discuss some policy options for rebuilding fiscal buffer at the end. Let me first start with the fiscal development in ASEAN Plus 3 region. Without going into very detail, let me just point out a few key points that could be more relevant to some of the points that we will discuss later. First one is higher debt ratio. As we all know, the pandemic-related spending was quite sizable. Therefore, it led to substantial the fiscal stimulus. But despite of this sizable stimulus, the prolonged pandemic basically brought the substantial damage to the economic activity, which basically compelled the older government extend their expansionary fiscal policy for the period a lot longer than they expected at the beginning. As a result, the debt to GDP ratio has increased quite a bit, as you can see on the left-hand side figure. Well, these figures are from our paper, so that we use the country name acronyms. Many of them are quite intuitive, but let me go over these country acronyms just for one time to introduce our member economies. The first country, KH, represents the Khmer, which is the old ancient name of Cambodia. CN for China, HK for Hong Kong, ID for Indonesia, KR for Korea, LA for Laos, MY for Malaysia, MM for Myanmar, PH for the Philippines, TH for Thailand, VN for Vietnam, JP for Japan, SG for Singapore. These are 13 economies. Actually, ASEAN Plus 3 covers 14 economies. The only country that is missing here is Brunei Darussalam, which we use BN for the acronym. In case of Brunei, there is no officially recognized debt at this point, so that's why we do not report this one, BN here. So as the left-hand side chart shows, the debt to GDP ratio has increased quite substantially, and then right-hand side shows that change in the debt to GDP ratio by contributor. One noticeable thing is the red bars, which represent the primary balance deficit. So for the last 3 years, the biggest contributor to the increase of debt to GDP ratio is basically fiscal expansion, which is represented by the increase of the primary balance. Of course, local currency depreciation in case of Laos, and then off-balance fiscal stimulus also contributed to the debt to GDP ratio increase. Interestingly, the growth impact, real GDP growth impact, now turn more into the regular situation, which means the strong economic rebound in recent years basically offset all the negative impact in the beginning of the pandemic. The second point is the more visible fiscal consolidation in 2023. So left-hand side chart shows the fiscal balance of the member economies from 2019 up to 2022. In 2021, most economies narrowed their fiscal deficit, and in 2022, the fiscal developments were a little bit more divergent. So fiscal deficit narrowed in about half of the economies, while the other half they saw the expansion of the fiscal deficit. A few main factors behind this divergent feature, but two main ones are higher commodity price, which basically improved the fiscal balance in commodity exporters, and also the resurgence of Omicron variant, which compelled the government to expand their fiscal balance further to support the economy. But as you can see on the right-hand side, more countries, almost all countries, seek to improve the fiscal balance in 2023 with a clear indication to restore the fiscal buffer, together with the emphasis on supporting the national development priorities, which were delayed during the pandemic. The last point is about the gradual fiscal consolidation. Even if we saw the gradual shift in the fiscal policy direction in 2023, not all countries published their medium-term plan. But in case of where the medium-term plan is available, it seems like the planned fiscal consolidation is quite gradual. Left-hand side shows the fiscal balance for the next 5 years in comparison with the 5-year average before the pandemic. So not every country were able to return to the pre-pandemic level of the fiscal balance within the medium-term time frame. This gradual fiscal consolidation implies it'll take a while to see the decline in the debt to GDP ratio, as you can see in the right-hand side. Let me check some of the key policy challenges for the fiscal authorities are facing at this point. The first challenge is the narrower fiscal buffer. The left-hand side table shows the comparison of AMLO staff assessment of the fiscal space before the pandemic and the 2023. Fortunately, most of member economies were able to enter the pandemic period with relatively sufficient or comfortable level of the fiscal buffer, which enabled them to provide the sizable fiscal stimulus during the pandemic, which also helped to maintain the robust economic performance during the pandemic, as well as the earlier recovery of after the pandemic. But after that, after 3 years of the start of the pandemic, most member economies now assessed to have substantially narrower fiscal buffer compared to the past. The second point is the elevated debt service burden. So as you have seen, debt level has increased quite a lot, which implies the amortization need will remain high for the coming years. At the same time, interest rate, as you can see on the right-hand side, increased quite a lot as well, which means that the new issuance of government bond will become expensive, and then interest payment burden will gradually increase in the medium term. The third point is that the continuing need or demand for fiscal policy. So overall economic performance has improved quite a lot recently, but some sectors and some group of people didn't get the benefit of this recovery, and then that required a substantial or continued or new type of support for those people and those sectors. On top of that, the monetary policy had to remain quite tight because of the inflationary pressure, as well as to support their currencies under the global financial tightening cycle. And at the same time, the downside risks remain quite elevated in the ASEAN Plus region, including the Russia-Ukraine conflict and geopolitical tension. Therefore, fiscal policy may need to lead the fiscal response if some additional shock materialize in coming years. Another challenge is coming from long-term and structural challenges like population aging, climate change, infrastructure gap, and these things. As you can see on the left-hand side, 9 out of 14 economies will turn into post-aged society in 40 years. And that becomes the huge the fiscal burden is expected for these countries. Infrastructure gap is also another factor that require additional fiscal spending in coming years, especially because during the pandemic, many large infrastructure projects were delayed due to the health concerns and may need to the increase to make up the delays happened in the past. Otherwise, this infrastructure gap will be the binding constraint for the economic performance in coming years. And fiscal policy is the one that is expected to play a key role in addressing these structural issues. Let me move on to the policy issues. So what we see as the most challenging policy issue at this point is maintain the tricky balance between rebuilding fiscal buffer and providing the adequate support. So as we have discussed, the above-mentioned risk, like the deteriorated fiscal position and fiscal sustainability concerns and elevated uncertainties, all these indicate that fiscal authorities need to quickly rebuild fiscal buffer to address these issues. At the same time, economic situation as well as the outlook and policy environment requires the fiscal policy to provide some support as needed. So maintaining this tricky balance between the two seemingly conflicting the policy directions, rebuilding fiscal buffer requires the consolidation, while providing adequate buffer will slow down the consolidation. Maintaining the balance between these two strategically will be one of the key issues that in the fiscal management going forward. In particular, we would like to highlight the 3 aspects of this transition. The first one is that fiscal normalization, which already happening in many economies, should be carefully calibrated, and fiscal consolidation need to be well planned. And the fiscal reforms and structural reforms are very critical in this transition. Let me go over this aspect a little bit more closely. First, in the short term, the key question is that how to normalize, with the due consideration that the economic recovery is uneven, and there exists still some need for continued or additional new support. So under the general direction of the fiscal consolidation, the transition from the broad-based supportive measures to the more targeted and time-bound measures is something that is widely accepted by member authorities. Of course, how to make this transition happen in a more desirable and more sustainable way is something that is critical to different countries with, where the policy choices will be quite important. In general, strengthening the social safety nets should be strengthened in many cases, and sufficient institutional capacity are crucial for the effective targeting and efficient benefit delivery. Meanwhile, as I said, the uncertainty remains quite high. Therefore, fiscal policy should remain quite flexible to address any policy need in case that some downside risk materializes, especially when the monetary policy is constrained due to other factors. The second point is for the need for a clear medium-term fiscal consolidation plan with specific targets and measures. The specific fiscal consolidation targets and measures are very important in keeping the fiscal management in the right course for the fiscal consolidation, especially when there is a temporary deviation from the consolidation path due to the necessary response to the evolving economic situation, as I just mentioned. And for this successful fiscal consolidation targets should be based on the reliable macroeconomic projections, and fiscal consolidation measures should reflect the country-specific policy environment. As we all know, any overly optimistic or overly ambitious fiscal consolidation targets and unrealistic measures to achieve the targets will damage the credibility of any consolidation plan. Sometimes fiscal rules can play a very important role to strengthen the fiscal discipline and then for the successful fiscal consolidation. So for those countries who dropped or relaxed the fiscal rules during the pandemic, they may review and reintroduce the fiscal rules together with their fiscal consolidation plan. And for those countries who do not have the fiscal rules, may consider to introduce the fiscal rules to strengthen their fiscal discipline for a successful fiscal consolidation. The last one is the importance of structural and fiscal reforms to facilitate the resource allocation that is very important in the post-pandemic era. The policy response to the pandemic was quite sizable. Therefore, any normalization, basically the withdrawing these things, require equally sizable fiscal resource allocation. Actually, this is a great opportunity for many fiscal authorities to completely realign the overall resource allocation along the various policy objectives, either the existing ones as well as newly emerging ones, where the comprehensive spending review as well as the other resource review can facilitate these things. As I mentioned, the structural reform and fiscal reforms can greatly facilitate this reallocation, resource reallocation processes to better address the emerging and existing policy priorities going forward. In addition, these reforms, the structural and the fiscal reforms, can improve the policy responses in a sustainable way so that the fiscal sustainability also can improve through these measures. One last point that I would like to highlight related to this reform is that, as you have seen, we just mentioned the trade-off between two options. But these reforms can also mediate the trade-off between these two seemingly conflicting objectives. For example, like the structural reforms to improve the resilience of the economy will reduce the needed size of the fiscal buffer that the fiscal authorities need to rebuild, because the trade-off will be less severe through the additional structural reform. Also, we need to consider not just the fiscal policy side, but also the comprehensively all the policy measures the government is available to the government to make these supportive reforms more effective, so that this post-pandemic fiscal adjustment process will become less painful in other ways. Thank you so much.
Dear Luke, thank you for your insightful presentation. Fiscal adjustments appear very necessary for long-term public finance sustainability in ASEAN +3 economies. Now, I'm pleased to present the next panelist, Oscar Valencia, who will provide valuable insights about the Latin American regions. Welcome, Oscar. The floor is yours.
Thank you, Yader, and thank you very much, Vlad, for this space. It's very interesting having this kind of analysis and comparative analysis, and in this case, Asian and Latin American. And I will focus most of the point on make the parallelisms of with respect of the great presentation that Luke made about what is the implication in terms of for our countries in Latin America and the Caribbean. So, please, okay, it's working. So in my intervention, I will focus using the same framework as Luke just presented. So in the first part, I will talk about the fiscal normalization in Latin America and the Caribbean. Then I will talk about the fiscal consolidation plans. What are the type of fiscal consolidation? How this? What are the characterization of these plans? And in a parallel way, what are the type of structural reform? And here I would like to highlight, in the case of Latin America, it's not only useful, this structural reform, but also the fiscal management, how we can use technology to attack the main problem that we have in our regions. So in the case of normalization, this is our two important graph. This is the distribution of the primary balance that we have in Latin America. So the red line, the left-hand side is the average, and the gray is the median, and we have in the dotted lines percentile 25 and 75. So what we see is that a huge ample space in 2020 that account more or less for 5 percentage point of GDP. That's a lot of countries made us sizable announcement and implementation of packages to attend the vulnerable population and firms. And then we had a normalization path that depends a lot on how the shock start to be evolved. So we had previously the mixed shock between supply and demand. Right now, we have more mixed, more supply persistent shock, and we had some rebounds, very important rebounds in terms of growth in 2021 and 2022 that make the adjustment more feasible. So in the right-hand side, what we have is the distribution across country. So in general, what the way how normalized our economy was a reduction in current expenditure of 3 percentage point of GDP. That's the comparison that we have with respect to the pandemic levels, and recovery in terms of revenues, fiscal revenues, for 2% of GDP, which are quite sizable. And very, very important news here that a few countries make adjustments through investment expenditure. And the second good news that we compare, for example, with respect to the global financial crisis. In the global financial crisis, also the country in the region make important stimulus about what so difficult for our countries to retrieve this stimulus. So in Latin America, this case we learned this lesson. We have a recovery in terms of the primary balance. But as I said before, as the shock start to mute, more persistent shocks, so we had in our region sizable inflation rates, and there is a stimulus, fiscal stimulus, to mitigate the negative impact of this impact of the inflation in our economy. So here, so the fiscal response on average in Latin America is 0.6 of the GDP, a lot of heterogeneity. We have On one side, net importers that on average between 0.4 and 0.7 of GDP of these measures, and we have the net exporters, and the net exporters have two sides. On the revenue part, so they are receiving because the better prices in oil, copper, and other commodities received important fiscal revenues that in the case of 2022 was around 2% of GDP, between 2 and 2.5% of GDP, and we are expected 1.34 for this year. Still are important, and it's not only tax revenue or capital revenue for our countries. And we have also the part of expenditure. So very interesting, the case of Latin America, the net exporter have more subsidies than net importers. So some countries in Latin America that the size of the subsidy between 2.5 and 5% of GDP. And most of the cases, this balance are financing with more debt. So what are the typical measures that make the Latin American country target cash transfer, subsidies, and prices on energy and fuels? So what is happening with respect to debt? So what we see so far is a correction in the primary balance. So between 2019 and 20, we saw a huge increase, 14 percentage point of gross debt in Latin America, but was a acceleration of the debt. But even before, the debt in Latin America was increasing. What we see in the distribution of the debt even was near to the percentile 75. So what we see after in 2021 and 2022 was a slight reduction because the inflation and the surprise inflation and also recovery in GDP, but still the cost of borrowing is something that is creating a lot of pressure in the new outlook. So in the right-hand side, the debt decomposition, I want to highlight the fact of the interest payments, and also even if the inflation surprise reduce the debt, the cost of borrowing is quite important, and have also very clear implication in the case in country we have a transmission with exchange rate depreciation creating valuation effect on the public debt. That is the case, for example, of commodity countries. So these are some examples of the cost of borrowing. These are the yield curve in lag 5. What we see is a shift in the most of the curves, or in some cases inverted. That depends a lot also of the reaction, the monetary policy to anchor the inflation expectation, and how these increments in the monetary policy are translated to the curves. And the size and the debt services, interest payments plus amortization is quite important for in the short term. So for 2023, we have 7 countries in the region that the debt service is above 5% of GDP. To give you a sense of these numbers, the standard investment that make Latin America and the Caribbean in education and health is between 4 and 6% of GDP. So that make difficult choice for our country. So we have other 6 countries that the debt service is between 2.5 and 5% of GDP. So one risk that we have here, the debt service in dollar weighted is larger in the most important economies. And also what we see is more concentration in the short term. So what we see here is a huge window opportunity to a smooth amortization schedule, but depends a lot of the institutional framework that have our countries, how they design the debt strategy, how strengthen the debt managers departments. And in this case, MDBs can help providing contracyclical funding and also more long-term loans to enhance the fiscal multipliers. So what about consolidation? So consolidation, we have a survey that make our country economists in the bank about the consolidation plans. So what we found is 84% of our country have planned consolidation plans and account for at least 1% of GDP. So what is very important. So how is this distributed, the consolidation plans? 40% expenditure cuts. There are 25% that is the consolidation that is involved in the IMF program. So several countries in our region are in IMF program. 200% tax reforms, and 55% the implied fiscal adjustment that are in the fiscal rules, and depends a lot on the compliance of the fiscal rules that we'll talk about later. So how we can make the consolidation? We just released our flagship dealing with debt this year, and in that flagship we compute the consolidation paths according with what we call the prudent level of debt. So what is this concept of prudent level of debt? Is the level in which the country can manage their own risks depending on the market characteristics. So it's like having a level of debt that the country can self-insurance against global and idiosyncratic shocks. So on average for Latin America and the Caribbean, we have that the range of the prudent level is between 46 and 55%. And still we expect that the path of the debt is decreasing in an inertial scenario. Is far away what we had in the pre-pandemic. And this point in the pre-pandemic was not a very good point because, as I said before, was an upper increased trend in the debt. So we have heterogeneity across countries depending on the economic characteristics. So for example, we have the tourism dependent have other numbers, and it's very important because the tourism dependent can higher prudent level of debt because they are exerting a lot of fiscal effort. So in general, the range is quite important, and the important thing here is what it implies fiscal adjustment. So on average, the fiscal adjustment 1.4% of GDP. So what implies this number? The traditional tax reform in the regions renders additional revenues between 0.7 and 1 point of GDP. So that's a sizable fiscal adjustment, and how we can make this fiscal adjustment in the region to converge to the prudent level of debt depending on the strengthening of each country. In the region, we have countries with higher revenues, so the adjustment goes through government expenditure, but in most of the cases of the countries is more mixed adjustment. So this is one of my favorite charts that we call the Cartesian explain. So that in the y-size we have the debt interest payment or the fiscal revenue. This is a proxy for the repayment capacity of the country. This indicator is called in the credit rating is called the debt affordability. And on the x-size, we have the gross debt. So we have 4 regions. The region 1 is the low debt and high level of affordability. Region 2 is low debt but low level of affordability. Region 3, high debt and low level high level of affordability. And the more complicated region 4, high level of debt and low level of affordability. So what we had in the pandemic, we were in region 4, the more complicated region with high level of debt and lower level of affordability. 22 was a recovery, but still we are in the same region. If we stay in the inertial scenario, so we will move very slowly to region 3. So still it's very complicated because we need to manage the high level of debt. So what implies converge to the prudent level of debt is going to the zone 1 that is more the safety. And this is very important as the name of the panel to create fiscal space, to enhance growth, and to attend more the vulnerable population in our region. So what is the type of structural reform? As I said before, I would like to focus also in fiscal management. So 2 pillars: increase the quality of the public spending and revenue mobilization. So how we enhance this quality on public spending? So through two targets: increase the technical efficiency and also allocative efficiency. So implies have better mechanism to targeting and to have strengthening the public procurement. Allocative efficiency, we need to have a institutional arrangement to prioritize budget and make better pre-selection and implementation of the investment plans. Sectoral review and public expenditure are quite crucial, are very important in the quality in institutional side expenditure quality units. In terms of revenue mobilization, we need to strengthen our tax authorities, give more technology, and increase the capacity of increased revenue. We have examples in Chile, Brazil, and Colombia in which that's strengthening the tax authority have a positive impact on revenue. But very important also is strengthening the tax policy. So we need to increase revenue, diminishing the distortion that creating taxes, but also increase the capacity of our Minister of Finance to evaluate impacts and to increase transparency. So one constraint that we have is inequality. So here is the Gini, the market Gini, the green dotted points, and the bars are the green are the disposable income Gini, and the orange bar are the disposable income Gini for Latin America. So what we see the disposable is the Gini adjusted by fiscal policy. So we see a huge difference between the market Gini and disposable income Gini for the OECD, and not the case for Latin America. So what implies this graph is the low level of redistribution of our economy. How we tackle this? So first, we need to understand and find the leakages of target expended. So in our previous flagship to 2018, our research found that we can make savings around 1.7 of GDP. Second, in terms of redistribution, in the case, for example, of the issue of the BIT, the tax expenditure is pro-rich. So go through more highest quantile of the distribution. So there are room to improve redistribution. How we can do in this case? One possible way is personalized BIT, and the personalized BIT offers a redistributed impact. In the right-hand side, some estimate how will impact this type of policy in terms of redistribution in our countries. This is our research that we had in the Fiscal Management Division. Also have positive benefits in increasing economy efficiency and also lower informality. Example of this is automatic return channel. We have two examples in Ecuador and Brazil. In Ecuador, 175,000 beneficiaries, and was a refund of 76 million in tax refund, and in Brazil, 600,000 registered household, and the return for 45 million in transfer for 2022. So that is happening right now in the region, but we need to foster it in the other regions and make more targeting and increase the redistributional power. Second example, inefficiency in public procurement. The government is a huge actor in the market. They are buying a lot of goods and services, but still there are ways to make savings. So our research found that the savings in the region for this concept can be around 1.4 of GDP. Two cases, Brazil again, for example, use the framework agreements leads to a reduction in 30% in the unit prices in comparison with other procurement methods. In an state, Rio Grande do Sul in Brazil, the savings can be between 13 and 80%. So if they are using reference prices based on invoice. So this is all result that is based on a specific research that we done in the Fiscal Management Division on this issue. Second issue, institutional. Fiscal rule was a gradual implementation. Right now, 48% of the fiscal rule in the region. Most of the rules are based on budget balance, second, expenditure, and third, debt. But having the fiscal rule is not enough to create this fiscal buffer. We need to strengthen the quality. So here we measure the compliance rate. The compliance rate in the region is around 66% of GDP. And very paradoxically, there is more compliance in rules that have on targets on debt and structural balance. So we advocate, and that's one conclusion of our flagship, to have the fiscal rules, but the anchor of the fiscal rule. And this anchor is very important because allowed have more instrument for the convergence to the targets. So, and also is create a complementarity between the rules, the medium-term fiscal framework, and the debt strategies. And also have very important implication on the market. Here, for example, the role of the fiscal rule compliance in avoiding the debt spike. Here we compare the compliers of fiscal rule with respect to the non-compliers. This is a very recent result of our research. And we have positive impacts in terms of avoiding debt spikes, also reducing the cost of financing and have a very credit rating. And why is important? Because we want to avoid debt overhang issues. We want to avoid that the debt create constraint on the size. And I will conclude with this because this is other constraint. We have informal sector is 60% of the work in the region. We have tax burden of our labor markets. What type of policy we can do here? So we have experience in the region. For example, in the case of Colombia, reduction in the payroll taxes. The reform 2012 helps to reduce at least 5 percentage point the rate of informality. But still, what we see from that year to now, that there was other factor and more important was increase the human capital to have better labor supply. So other type of policy is the negative income tax. So this is other research that we had in the division. And the simulation suggests that the negative labor tax increased incentive to formalize, even a rate of 70% in some countries, has very important impacts on economic growth. So the dividend doing that is quite feasible and can an option to reduce informality. Also the simplified tax regime. So we have a lot of experience in the region. There are pros and cons, but in general, is if they're well designed, reduce the cost of transaction and create incentive to formalization. So I will conclude here. So what we see on general in the region, we draw the fiscal stimulus. There is a lot of work to do in terms of the public debt, to reducing the burden, to avoid the overhangs. Probably some countries are suffering of this right now. But we have the policies to attack this. The policies are concentrated on the expenditure side, targeting, more efficient and enhancing the fiscal multipliers. And in the revenue side, we need to mobilize more resources, strengthen our tax authority, and make more effective our instruments. And I chose some example that is ongoing in our region. So what we need is to expand this example and make evaluation and improve day-to-day our implementation of the fiscal policy. Thank you very much.
Thank you, Oscar, for your outstanding presentation and analysis. Your observation greatly contribute to our understanding of debt and fiscal space in Latin America. It appears from your observation that Latin American regions share certain similarities with Asia. After receiving insightful information from the presentation, we will now move on to our Q&A session. We have selected a set of audience questions to answer, and we apologize for missed queries. We will ask identical questions about both regions to get a comparison framework. So look, let's begin with your perspective on Asia. And the question is that given the current scenario of high inflation, increasing interest rates, and fluctuating commodity prices, mounting no concern regarding the sustainability of debt and fiscal policies exist. So how do these factors affect your respective regions' approach to managing public debt and implementing fiscal policies?
Thank you for an interesting question. Well, I think these factors affect the individual economies in different ways, so that which implies that fiscal policy response are supposed to be diversified in reflecting the country economic situation. But anyway, these factors indeed make the fiscal authorities' role more challenging and then more complex. For example, like the high commodity prices, it has benefited some commodity exporters in particular with the substantial windfall gains, improving their fiscal balance. while they also pushed up the spending side, especially the countries where they maintain the substantial energy subsidy programs, and also some of the expenditures are indexed to inflation. Also, the higher inflation affect the fiscal situation of member economies in a little bit more uniform direction, like higher revenues coming from the general inflationary pressure, and also the spending. But the magnitude of the impact varied quite a bit depending on the spending structure as well as the tax structure. Some countries, more portion of the spending is indexed to the inflation, while some others are not. And also the composition of that. So for the typical example is the pension spending, for example. Like the pension spending are usually indexed to the inflation, while some others. So these changes matters a lot in terms of the magnitude of the impact, and also the revenue side. So some countries, their tax brackets are designed to be indexed to inflation, while some others are not. So they have the different implication, these things, but also, but of course, they are moving into similar direction. So, and on top of these structural parts, how the country respond to these challenges make a substantial difference in terms of the fiscal situation, the resulting fiscal situation. So some countries were more active in terms of supporting those who are affected by high inflation, while some others try to maintain their already developed social safety nets to handle all these issues. So it is a little bit hard to change the differentiate or what substantial changes this challenging situation cause in terms of the approaches. But existing the system is trying to accommodate all these things. So overall, to better manage these challenges within the framework requires the substantial improvement in the PFM. So this pandemic, as well as the following high inflationary and high interest rate framework, basically help the authorities realize the substantial challenge in terms of their existing PFM framework, so that they felt that, oh, we need to improve their this PFM to better manage these challenges going forward. Of course, they are still in the early stages, but they are making progress on that one, and then that will eventually help to strengthen their debt management, as well as the general policy policy actions that they use here. Let me stop here.
Thank you, Luke. Oscar, let us know your thoughts about Latin America.
Thank you. And as well, we know that the country is suffering a lot of the fluctuation of commodity prices, but here the message is clear. We need to have a better mechanism to target better the subsidies, the fuel subsidies, for example, in the region, and reduce it and have more focalization on this. Second issue is we see that there is a reduction in the financing need, but the share of the financing need corresponding to the services is quite high. So here there is a lot of room in terms of the debt management. So in general, what we see in the region is that extending maturities, but still we have issues of compositions. So the debt management is a complicated trade-off, because we need to have minimizing the risk, but also minimizing the cost. So our debt manager right now have an important trade-off to face, and the fiscal framework can contribute to this, decreasing the financing needs. And for decreasing the financing need means how we expend less and better, and how we credible design policies to reduce the debt in the medium term. For this reason, the debt anchor is quite crucial. And the third point is policy to enhance growth. Before the pandemic, the productivity rate in our Latin American country was negative. The shock in the pandemic is a shock that hit directly to the potential output. So we see a recovery, but still the long-term forces for economic growth are missing. So a lot of misallocations. Western resource in productivity. So we have a lot of gaps in terms of education, health, and although we have a huge challenge in climate change that affect economic growth and the volatility of economic growth are very important. We need an agenda to fostering economic growth and have clear paths on the medium term on this. So,
Great, Oscar. Now moving to the second question, let me start with you, Oscar, this time. Many countries worldwide are facing high inflation levels. However, the type of inflation is not necessarily the same. It could come from supply or demand sources. So do these differences have an impact in terms of sustainability analysis? If so, how?
Thank you, Yair. So that's very interesting question, and Tosha, recent research we're doing in the bank. So yeah, so what we see that inflation surprise is a one-off benefit in reducing debt, but at the same time increasing the cost of borrowing. So, but the source of inflation are quite different. What we can expect is inflation coming from higher demand, for example, when the potential, the output gap is positive and have pressure on prices. On the other side, we have cost shocks that are affecting the prices and increase inflation that we call the supply shocks. So in our research, what we found is demand shocks are more often associated with reduction in debt. Instead, supply shocks are associated with increase in debt. And when we look around, the channel transmission on this is the cost of financing. So the cost of finance is reducing the capacity of repayment. And that's very important, not only because affecting in the short term, but also in the medium term. So the implication is still very, very crucial here, because if you wanna control inflation, have important implication on the fiscal side. So one part is you need to cool down the pressure of the demand or the fiscal accounts on prices to have better space to have the better space to attack the impact of the supply shock. So it's a coordinating policy between the monetary and fiscal policy. The second issue is how you manage these supply shocks over the time, what is manageable in the country and what are pure external shocks, and converging low level of the helps to do that.
Thank you. Great. So let us know your perspective, Luke.
I agree with Oscar that it is a really interesting, intriguing question. But when I thought about this one, let me go to a little bit more intuitive, theoretic, the explanation. So this cost push inflation and then demand pull inflation, they're quite, I mean, from the inflation point of view, it is the rise of the price level, but the other macroeconomic implication can be quite different. So usually the cost push is like a more contractionary in terms of the output, while the demand pull case is more expansionary in terms of the output. Therefore, the usual, I mean, of course, depending on the macroeconomic situation, the government response is a little bit different. So how to deal with the inflationary pressure, whether depending on the sources of the inflation. And then that actually result in the fiscal situation, the debt situation, because there is a difference in the policy responses to depending on the sources of the inflation. So probably what we'll see in terms of the debt to GDP ratio, fiscal expansion, whether it is a fiscal expansion, whether it's a fiscal contraction, in terms of the policy response, as well as whether it is expansionary in terms of the nature or contraction in terms of nature, will lead to the eventual debt to GDP ratio changes depending on the sources. But in terms of the approach in the debt sustainability analysis, I cannot imagine any substantial differences in terms of the debt sustainability analysis framework itself.
Thank you, Luke. So I will start the question number three with you, Luke, again, and it's about fiscal consolidation. So fiscal consolidation by increasing tax revenues may discourage foreign investors from investing in a country that adopts such measures. So given the particularities of countries in each region, how can economic policy authorities mitigate such risks and increase tax revenues without affecting capital inflows?
I think we need to keep in mind that the revenue side is, of course, it is very important, but it is only one measure for the fiscal consolidation target. And then, of course, we mentioned briefly in our policy perspective paper, this raising tax revenue is usually not a preferred method, especially the economic outlook is not very bright. Because it is something that will, supposed to be in theory, discourage the economic activities. Of course, there are cases that that this one becomes relevant because economic situation evolves, and then sometimes the existing tax structure will deteriorate will cause lots of trouble in terms of the efficient resource allocation, and even deteriorate the economic outlook because of this distortion in the resource the allocation through the tax system. Otherwise, it's a lot better at this point, at this juncture, to consider other methods. For example, like the tax rate impact on the FDI is an important issue, but in some cases, it may not be that relevant, especially depending on the type of FDI. So FDI, even if the low-income countries tend to provide the tax benefits to reduce the effective tax rate as a way to attract more FDI. But some FDIs, they don't care that much about the cost difference. What matters is, for example, like the mineral deposits or location of some of the favorable natural the resources or the sites that make better in terms of the other things. Of course, that's something the government, a tax authority especially, have a keen eye on differentiated things. So before actually touching on the tax rate, and also the impact of the tax rate on the FDI, not only affect the FDI, but also the other the economic agents, domestic economic agents. So lots of other things are concerned. I think what we, and also what Oscar suggested, this administrative capacity enhancement may have the better result at this juncture, before we finally review the tax structure overall, whether it is pro-growth or not.
Thank you. Oscar, let us know.
Yeah, I completely agree with Luca's points. And I will add other point, volatility. It's more complicated, not the tax, but if the country have a lot of volatility in terms of the tax rate, because we have investment decision. This investment decision takes time. So we are changing the rule most of the time. So the investors are discounting this type of uncertainty and make less investment. That's an implication of a standard Q towing approach. Okay. So and we see also in empirical papers that, for example, if the fiscal discipline create more incentive to invest, and not only in FDI, but also in portfolio. So as long as you see like a dividend creating the primary surplus, taking in the value present, this is a dividend on a set of assets, of the public assets. Because in other words, you are saying we have enough resources to provide public goods that are reducing the cost of transaction. And that's very important and connect with the look point of make investment more attractive. So the point is how we close these infrastructure gaps and how we make more friendly the investment. And this is one very crucial point in Latin America, because several countries in our region are suffering on twin deficit. And the twin deficit, the point is how you finance the current account deficit. If you have more speculative approach, that's more complicated. But you have some regions that have fiscal deficit and the current account is financed with high diversified FDI. So how you create this diversification depends on the opportunity that have the country, and that depends a lot on the economic condition to make business. That's more crucial here. Thank you.
Excellent. Let me move to a new question. So Asia and Latin America have significant labor informality levels, as you mentioned in your presentation, which affect fiscal consolidation in different ways. So how can government reduce the adverse effect of labor informality on fiscal and public debt sustainability? So please start, Oscar, with you this time.
I mentioned very quickly in the presentation, but we have several instruments. But what we see in recent experience, the most important is human capital. Human capital is the key, because what we see is the tipping point between being formal and informal is high correlated with low skilled labor. So allocating to have more high skilled labor and also creating a sort of effects on the demand side. What we see, for example, that it is a typical shock for Colombia, labor supply, but also migration. So we see positive benefits on the demand side if you have high skilled labor and see complementarity. Instead, you have low skilled labor, make more complicated. We have tax policy to attack the informality, as I mentioned before, reduction in payroll taxes, negative income taxes, but it's not working at all if you don't have a comprehensive view of how attack informality and enhancing growth. That's an issue, and it's not for labor market, but also for the firms. The entrepreneurial informality is quite high, and the cost of entry and the high exit rates affect a lot of the productivity. So that's some issue that we need to consider in this regard.
Thank you, Oscar. Let me pass the same question to you, Luke.
Okay, I totally agree what Oscar mentioned about the productivity aspect. And let me focus a little bit on the fiscal impact. The informality is a little bit more bigger issue in the developing and low-income countries, and then they are quite serious about the not only from the growth perspective, but also some other the sustainable development goal in general for that perspective. They have a multi-dimensional policies, and then it is very critical to have a careful assessment of the decreasing informality and then make them to pay. And at the same time, there is an implication on the expenditure side as well, because for the sustainable development goal, the most countries are working very hard to expand their social safety nets as well. And most of the time in low-income countries, those informality are the one who may affect the demand for social security as well. It is a good thing, but from the design as well as the total implication, the whole implication on the public finance should be considered with the future, the dynamic implication on that side. In terms of the measures, what was successful in our region is to use both the benefit and the cost together with some of the carrots and then sticks. So make it clear that most informal sector workers, the problem is that the informal sector workers are not fully aware of that, of the benefits and costs of being formal. So they only focus on the cost of being formal, so additional money that they need to contribute and so on. But at the same time, they are the policy target for the government, for sure, for the benefit, giving the benefit. So helping them to make the informed decision is very important. And at the same time, due to the system becomes the big barrier to become the formal sector workers. So reducing the cost of this transition from the informal to formal becomes another big issue, and make it the more dynamic in the sense that once the group of people become the formal sector, formal workers from the informal worker, it is very hard to make them to go back to the informal worker. So use the temporary, the incentive mechanism, and then the very scary penalties, temporary, was found very successful together with the effort to reduce the cost of being formal. Was a very effective way to increase the formality in the labor market, and then which possibly, better help the labor market policies, which will drive the proper labor market, the contribution for the growth potential.
Thank you, Luke. I think so. we have time for one or two more round of questions. So look, let me start again with a new question. So another important aspect of public debt sustainability analysis is liquidity risk, often assessed by the size of gross financing needs. So how will high interest rate and inflation impact the services and gross financing needs in Asia and Latin America, respectively?
As I briefly mentioned in the slide, one of the big concern and then also the challenge for the fiscal authority and then debt managers at this point is that substantial increase in the debt service burden. So substantial financing for the pandemic-related spending was done in some cases the short-term financing, and that now they are amortizing. I mean, they need to the refinance at this point. Of course, now it becomes a little bit more strategic to spread out the maturity of these things. But still, we are expecting that this amortization need will remain high for a while. And also the higher interest rate. It is not just the policy rate, but also the global financial condition have a substantial impact on the refinancing cost, which will basically increase the debt to the interest payment burden gradually. The particularly vulnerable group is the country with high external debt. So especially if the foreign currency debt. One of the countries in our member, they experience like this 40% point increase in the debt to GDP ratio simply because of the local currency depreciation. So of course, for that one, there are huge stories about the macroeconomic stability, but from the debt management point of view and the liquidity rollover risk, is subject to this kind of substantial risk. So with the higher the debt service burden, basically translate into higher risk of the rollover as well as the FX risk.
Thank you. Now your turn, Oscar.
Thank you, Eddie. It's not easy question to answer. So I agree with the look point. So the rollover risk here have a global condition very tight for our country. Also the how these global conditions translated to exchange rate depreciation as our country rely a lot on external financing, foreign currency, so that affect directly without make anything because all the appreciation. So, but still we have some space to do things, and here I consider the debt strategy is crucial. So the debt strategy is embedded on this, how we minimize the risks of rollover over the time, but that's implied that the new issuance must be according with the anchors, the debt anchors. So for this reason, I highlight a lot that right now we need to thinking about it, have a fiscal forward guidance to very clear to the anchors, to the prudent levels, and that create an additional role to manage its expectation in the market, even if the interest rate is quite high. So you have a space if you are credible enough to manage the cost of financing over time. Second issue, the investor base. Investor base is crucial. So are not the same the investors that are financing debt with the investment grade or with respect to the more or below the investment grade. So the investor base is important for a country, because even if the financing conditions are worsened and you have very diversified long-term investor base, it's not a problem at all of financing, because it's happened that the balances start to correct, the financing needs to be more adjusted, so the cost of finances in the future will reduce it. So the investor base is quite crucial here, and that there is a risk, of course, because what we see, for example, in local markets, the share of the foreign investor in local market have been increasing in the recent years. So we need to thinking about policies also to have more diversified investor rate, and also thinking about the asset price, asset part of our balance sheet of the public accounts, no? To leverage better our debt positions.
Okay, very interesting. So let me take a small advantage of your president and ask you a final question. Yes. So how have international credit ratings and investor perception of countries in these regions been affected by the pandemic-induced debt increases? And what steps can be taken to regain or maintain investor confidence? So let me start with you, Oscar, again.
Tough question. So credit ratings. So here depends what is how they are responding, but there are three pillars. Normally we see in credit ratings. One is how profound are the macroeconomic imbalances, and if not, the way to correct this in the near short term, so deteriorate a lot the rate, but also in institutional part. So in some credit ratings, if we see more effective in governments and rule of law and these kind of things are weighted higher the rate and the capacity of repayment of the country. So to answer your question, there is some factors that depends on the what is the recent trends of the country and what is the future outlook. So the point with the credit ratings is there are some countries in the same box. So as long as there is not a huge differentiation between countries, there is not expected to have changes in the rating. But of course, the country react in very different ways. So the outlook and the changes in the region depends a lot in the recent years how they reduce the fiscal stimulus and how they can maintain a convergence to sustainable paths in the near term. So that's crucial. Of course, the pressure on interest rates are quite high, but still, if the interest payments is still high and you increase revenue, so the capacity of repayment are increasing. So that's a space to manage, and the trend of that is crucial also in the ratings. If you have, even if you have low debt but increasing trend, can be a factor to deteriorate with respect to other peers.
Perspective. Okay. Look.
It is a very interesting question, and it is a little bit challenging to answer comprehensively. But out of many aspects, let me focus on one aspect. Of course, Oscar mentioned a few important parts. The part that I would like to highlight is the credibility of the fiscal policy. So what we have seen for the last 3 years, that as we have seen the substantial increase in debt to GDP ratio. Credit rating agencies do not blame the country for higher debt to GDP. Of course, they raise the concern about debt sustainability because, as we all discussed, higher debt service burden will become more challenging, and all these challenges make the debt level sustainable is more challenging than before. But it does not, they do not blame directly on the level of higher debt because it was necessary and it actually helped to economy to survive during the pandemic. Now the question is that what's going forward? So we basically praise them for doing responding to the pandemic in a nicer way. Anyway, after 3 years, the countries are recovering strongly. So they publish or they announce the plan to make their debt to GDP ratio more sustainable path through the consolidation and all the things. But if it is not credible, so that's where the problem will arise. And then transparency, especially for some of the low-income countries, they express the ambitious plan. Oh, then maybe they may be able to achieve it, but it is hard to believe the numbers because of the lack of transparency. So those institutional features may play a bigger role in coming years in terms of the maintaining or even strengthening the investor confidence in the government capital market. That's something that I would like to add to Oscar's results.
Thank you. Thank you all for your excellent presentation, which provide valuable insights and recommendations for policymakers to address challenges of high debt levels and promote sustainable economic growth in the post-pandemic era. Unfortunately, our time together has come to an end. We extend our gratitude to the speakers and attendees to being here today with us. We look forward to seeing all of you again in the next Clark Talks episode. Thank you. Bye-bye.